Warren Buffett, you only need to know these 7 rules and 2 ratios. Hello and welcome. Today, we dive into the investment wisdom of Warren Buffett, the greatest investor of all time. His track record speaks for itself, turning every dollar invested into $500,000. Today, we will explore the 7 rules that have led him to unparalleled success. Let's get started. Berkshire Hathaway, Buffett's company, has delivered significantly higher returns compared to the S&P 500. While the S&P 500 multiplied its value by 140, Berkshire has achieved an astonishing 10,000-fold increase. The difference is evident, and it all comes down to the rules we are about to discuss. Rule 1: Compound interest. Albert Einstein once said, "Compound interest is the most powerful force in the universe." Buffett understands this principle and applies it to his investments. Let's do a simple exercise to demonstrate its power. By reinvesting your gains, your wealth grows exponentially, creating a snowball effect. Even a small monthly contribution can make a significant difference in the long run. Harnessing the magic of compound interest, just like Buffett has, can transform your financial future. Rule 2: Avoid emotions and follow rationality. Emotions often drive investors to make irrational decisions. They get overly excited during bull markets and fearfully sell during downturns. But Buffett advises against following the crowd. Instead, he suggests staying rational and making decisions based on sound analysis and a long-term perspective. Don't be swayed by short-term market movements or the latest trends. Remember, investing is about the underlying value of a business, not daily fluctuations. Rule 3: Don't borrow to invest. Buffett warns against borrowing money to invest. Leverage can amplify gains, but it can also magnify losses. Rick Guerin, a former partner of Buffett, learned this the hard way during the 1973 crisis when margin calls forced him to sell his stocks at unfavorable prices. Avoid unnecessary risks by investing with your own capital and maintaining a conservative approach. Rule 4: Buy below intrinsic value. Buffett's success lies in buying stocks below their intrinsic value. Price and value are not the same. Price is what you pay, while value represents the real worth of a business. By buying undervalued stocks, you create a margin of safety and increase your potential for future gains. Buffett's investment in Apple exemplifies this principle, where he purchased it at a favorable price-to-earnings ratio, resulting in significant returns. Rule 5: Be patient. Buffett emphasizes the importance of patience in investing. Once he buys a stock, he is willing to wait indefinitely for it to reach its full potential. He uses the analogy of waiting for a good pitch in baseball. You don't have to swing at every opportunity that comes your way. Wait for the right moment, do thorough research, and invest when the odds are in your favor. Rule 6: Stick to your circle of competence. Buffett advises investing in businesses that you understand well. Stay within your circle of competence and focus on industries and companies that you can evaluate with confidence. Knowing the business, its economics, and the competitive landscape gives you an edge in making informed investment decisions. Don't venture into areas you don't comprehend. Rule 7: Maintain adequate liquidity. Buffett believes in having liquidity, which means keeping a portion of your portfolio in cash or liquid assets. This provides flexibility during market downturns and allows you to seize investment opportunities when others are selling in panic. Liquidity acts as a cushion and helps you capitalize on favorable investment opportunities even during turbulent times. It provides a sense of security and the ability to navigate unexpected events or market uncertainties. Buffett ensures he always has ample liquidity, allowing him to act swiftly and decisively when attractive investment opportunities arise. Extra rules: Never lose money. Buffett's first rule of investing is simple but powerful. Rule No. 1. Never lose money. Rule No. 2. Never forget Rule No. 1. While it may seem obvious, it highlights the importance of managing risk carefully and avoiding unnecessary mistakes. Before thinking about potential gains, consider the potential losses and prioritize the preservation of capital. By minimizing errors and focusing on investments with a higher probability of success, you increase your chances of long-term profitability. Buffett also emphasizes the significance of understanding the businesses you invest in. Trust your research, analysis, and instincts. Falling in love with stocks requires confidence in your abilities to evaluate companies and predict their future prospects. While seeking inspiration from successful investors is valuable, make sure to generate your own investment ideas based on thorough understanding and analysis. Conclusion: In conclusion, Warren Buffett's 7 rules, along with the 2 extra rules we discussed, provide a roadmap for successful investing. By harnessing the power of compound interest, avoiding emotional decision-making, staying within your circle of competence, and maintaining liquidity, you can build a solid foundation for long-term wealth accumulation. Remember, it's about patience, rationality, and a deep understanding of the businesses you invest in. As he said, price is what you pay, value is what you get. As part of our comprehensive approach to valuing stocks, we employ a game-changing method known as calculating the objective price. This strategy involves combining multiple metrics, including the price-to-book (PB) and price-to-earnings (PE) ratios. By comparing these ratios to industry averages, we can assess the attractiveness of a company and determine its fair price. Let's dive into an example to illustrate this approach. Suppose we are evaluating two companies, Hype Company, Value Company. For Hype Company, the industry average PE ratio is 10, while its PE ratio is 15. Applying the formula for potential capitalization, we find a negative value of minus 33.33%. This indicates that Hype Company may be overvalued compared to its industry peers, suggesting a potential decline in its capitalization. The fair PB ratio for Hype Company would be 0.67 or lower. On the other hand, Value Company has an industry average PE ratio of 10 and a PE ratio of 5. Calculating the potential capitalization, we obtain a positive value of 100%. This suggests that Value Company is undervalued relative to its industry peers, indicating potential capital appreciation. The fair PB ratio for Value Company would be 2 or lower. Potential capitalization equals industry average PE, company's PE 100%. Example 1, Hype Company industry average PE, 10, Hype Company's PE, 15. Using the formula for potential capitalization equals 10 to 15, 100% equals minus 5, 100% equals minus 33.33%. In this case, Hype Company has a higher PE ratio, 15, compared to the industry average, 10. The negative potential capitalization of minus 33.33% suggests that Hype Company may be overvalued in relation to its peers, indicating a potential for a decline in its capitalization. For Hype Company, potential capitalization equals 10 to 15, 100% equals minus 5, 100% equals minus 33.33%. Fair PB ratio equals 1 plus potential capitalization equals 1 plus minus 33.33% equals less than 0.67. Example 2, Value Company industry average PE, 10, Value Company's PE, 5. Using the formula for potential capitalization equals 10 to 5. 100% equals 5, 100% equals 100%. For Value Company, potential capitalization equals 10 to 5. 100% equals 5, 100% equals 100%. Fair PB ratio equals 1 plus potential capitalization equals 1 plus 100% equals less than 2. In the case of the Value Company, where the PE ratio is undervalued at 5, the fair PB ratio would be 2. This means that a PB ratio of 2 or lower would be considered fair to pay for the stock. By employing these calculations and considering industry averages, we gain insights into the relative attractiveness of different companies. It's important to trust our instincts and rely on the data when evaluating stocks. Just like in love, if we require excessive affirmation to convince ourselves of a stock's potential, it may not be the right fit for our portfolio. Confidence in our research and analysis is key. It's crucial to understand that investing has the potential to generate greater returns than simply saving money. While starting early provides more time to benefit from compounding, it's never too late to begin. Regardless of age, opportunities for growth and wealth creation are always present in the stock market. As the Chinese proverb goes, the best time to plant a tree was 10 years ago, but the second best time is now. We must embrace the present moment, take action, and seize the available opportunities. In conclusion, our approach to calculating the objective price of stocks, utilizing the PE and PB ratios, allows us to identify undervalued companies and position ourselves for potential capital appreciation. By trusting our research, making selective choices, and embracing the opportunities in front of us, we can fall in love with stocks and embark on a journey toward financial success. Remember, investing is a continuous learning process, and it's essential to stay informed and adapt to market dynamics. If you found this video helpful, please give it a thumbs up, consider subscribing to our channel, and share it with others who are interested in the stock market. Thank you for watching, and may your investment journey be rewarding and prosperous.